The market has been extremely turbulent over just the past week and really all of 2025. And so, how do investors avoid mistakes in a market like this? I think the biggest thing we need to do is go back to fundamentals. What companies are going to be able to survive and thrive no matter what happens with the economy, with tariffs, or with any sort of unknowns that aren't predictable right now. So, I'm going to go through three things that I'm looking at in my portfolio and in any stocks that I'm going to be adding in 2025. These are factors that are going to set investors up for success no matter the market conditions. And that's really the key here. So there's so many unknowns that we need to have companies that are resilient in this market, not that are going to fold if the wrong tariffs are put in place or if there's some sort of economic pullback later this year. So going to go through three things that I'm looking for. My name is Travis Hoium. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. And thanks to this video sponsor, The Motley Fool. If you go to fool.com/ASYM, they'll give you their top 10 stocks to buy right now. First thing I want to look at, and this is something that I've looked at for every stock in my portfolio, is the net cash position. Net cash is simply the cash that's on the balance sheet, so cash and short-term investments, minus the debt that's on the balance sheet. So a lot of companies that I own don't have any debt, so that's not really a risk factor. But some companies have a large cash position and then also have some debt on the balance sheet. This is a screener that I did. It's just companies that have a positive cash position. So on the right here, you see this is actually a net debt and it's negative. Apple, for example, has a $44.6 billion net cash position. NVIDIA has $32.9 billion. Alphabet, $67.5 billion. You can see all of these companies have a net positive cash position. And at least outside of the banks are kind of an outlier here because their business model is a little bit different. But if you're looking at a tech company or a manufacturer or a software company and they have a net positive cash position, that means that there's not some sort of overhang in the future that they're going to have to pay off. So for example, if you're a company like Rivian, you have debt on the balance sheet, you're going to eventually have to pay that off, and your operations are burning cash. So that's a really tough position to be in 2025, 2026, as you're expecting your production to increase. But there's a lot of projections out there. Are you going to be able to make as many vehicles as you thought you're going to? Are the margins going to be what you think? If they're not, if there is some sort of macro pullback, it could put you in a really tough position, which makes it much harder to refinance that debt in the future. If you're starting from a position where you have net cash on the balance sheet, it gives you a lot more flexibility. If we do go through some sort of pullback, think about what any of these companies could do. They could acquire competitors. They could reinvest in their own businesses. They could buy back stock. A lot of options if you're starting with a net cash position. So that's the first thing that I want to have in a market like this. The second thing is positive free cash flow or earnings. And this sounds simple, but it's really important if we do go through some sort of economic uncertainty. When we went through the recession in 2007, 2008, 2009, a lot of companies saw their revenue drop, their margins drop. And if you're starting from a position where you're at least making money, that means that you have some flexibility to be able to absorb a drop in margins or a decline in revenue that may last a year or two. A lot of companies today are not in that position. So if you're starting with a net debt position and you're losing money, that is a really, really tough position to be if there is a big dislocation in the market. So that's something I'm really trying to avoid, is those companies that are very, very high risk because their financials are negative on both the balance sheet and the income statement and statement of cash flows. So starting with a company that's positive free cash flow, has money coming in the door, or positive earnings, that's going to put you ahead of the game and again, give that company more flexibility in the future if there is some sort of dislocation in the market. Let's take an example like On Holding. On Holding has a 60% gross margin in their business. So they are going to be impacted by tariffs. But who's going to be hurt more by tariffs? Nike, who has a 44% gross margin, or On Holding? I think it's going to be Nike. Nike doesn't have the same pricing power, doesn't have the same cushion in their margins that On Holding does. That gives them much more flexibility. So that's just one example of where companies with high margins, with high free cash flow, with high net income are just going to have more flexibility to survive and eventually thrive if there is a recession or more dislocations in the market caused by tariffs or something happening, particularly in the US economy. Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. Number 3 is I want to get a good value for these stocks, a price to earnings multiple or price to free cash flow multiple. of under 20 is at least a good starting point. If you can get under 15, I think that's where I see a lot more value. If you have a price to free cash flow of under 15 and you have a good balance sheet, that's when you start to see a lot of optionality for companies and what they can do with their cash. So think about a company like MGM Resorts. MGM would be very heavily impacted if there is a pullback in the economy. They're in the entertainment business. People are going to travel less. They're going to go to hotels less. They're going to gamble less. That's going to impact their business. But they have a strong balance sheet and they have a very cheap stock. So management has said they basically have excess cash of $1 to $2 billion on the balance sheet, and their costs are pretty fixed. So even a pullback in their revenue is going to leave them probably with positive free cash flow. And in the event that the stock pulls back, management could continue buying back shares. They've been buying back about 15% of their shares outstanding over the past few years. That could increase without increasing the absolute dollars that they're actually investing because the stock price is coming down. So they could be buying back 25% of their shares outstanding if the market gives them that opportunity because they're leaning on that strong balance sheet, the strong free cash flow that's coming from the business. And then that may decline a little bit, but they're probably going to be positive free cash flow still because they're not building many new resorts right now. And that valuation is where you're going to get safety and optionality and upside when the market does recover. So those three things that I'm looking at with every stock that I'm analyzing or buying today is what does their balance sheet look like? Do they have net cash on the balance sheet? That's going to put them ahead of a lot of competitors. Do they have positive free cash flow or net income? Again, that gives you flexibility to be able to adjust if there's tariffs or if there's a pullback in the economy. And the third thing, are we paying an appropriate price? I don't want to pay 30 or 40 times earnings for a company that's not growing. But if I'm going to pay 10 to 15 times earning for a company that's maybe growing relatively slowly, who has the opportunity to buy back shares if there's a dislocation in the market, that's where I want to be. So if you have those three things right, you set yourself up for success. I've given a couple of examples here, but if you keep those three things in mind, I think that is going to set up investors to have a great 2025 and beyond as we look to long-term investments in the market. Let me know what you think in the comment section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.